Hello, my name is Marty Frenkel. I am chair of Maddin Hauser's Financial Services Group. Maddin Hauser has had the privilege for the last 40 years of serving the mortgage industry in nearly every aspect, from corporate and M&A, employment, litigation, licensing, regulatory, secondary market, vendor transactions, you name it. In all that time, however, it has become clear in certain circumstances that there is often a lack of understanding about the thing that we engage in the mortgage industry as a whole, the execution of a note mortgage and the servicing of a note mortgage. How do those documents function internally from a legal perspective? So we have decided to put together a series of videos to break down the function of the note and mortgage within a mortgage transaction. With me today is my colleague, Sydney Wright. Sydney, please tell the audience a little bit about yourself.
As Marty said, my name is Sydney Wright. I'm an associate here at Maddin Hauser, and I'm with the firm's financial services practice group. We assist mortgage lenders with various types of issues surrounding loans, and I'm here today to talk a little bit more about notes. Okay.
So thank you, Sydney. In one of our prior episodes, we had a bit of an overview breakdown of the note and mortgage. But today, you're going to drill down more deeply into the note itself. So what does that look like?
Right. So, in prior episodes, we've talked about the relationship between the mortgage document and the note document. Both serve different purposes, with the mortgage being tied to the real estate and the note document being the underlying debt that secures the mortgage. So, I'm going to be focusing on the note today and how those notes are transferred between lenders. This is important because it happens all the time. However, there are some very specific rules that relate to these types of transfers that must be followed to the T in order for the next lender to become an entity that can enforce the note, or in other words, recoup the underlying debt.
So just to understand, if in a prior episode we had talked about if an individual signs a promissory note in California and moves to Florida or New York, that note debt obligation follows them no matter where they go. But you're talking about if lender A loaned that money in California and decides that the borrower hasn't moved, but the note moves, that lender A sells the note to lender B to lender C, and so on. So what rules govern those transfers of the note between the various lenders?
There's a body of law called the Uniform Commercial Code, or as I'll call it, the UCC, that applies to business transactions in the U.S. This would include the transfer of what's known as a promissory note. And the notes that we're talking about in this series are a type of promissory note. So, under the UCC, there are various rules that must be met in order for a lender to be able to enforce the note, or in other words, recoup the underlying debt. One of those requirements is that the lender must be a holder, as defined by the UCC.
So let me interrupt you for a second. What does it mean to be a holder? Are there different types or ways the lender can be a holder?
Yes, there are. So a lender can be a holder in the sense that they possess the note, and that is not just a copy of the note. This is the original document, either with a wet ink signature or an electronic signature, which is important to ensure that the debt is not duplicated under the UCC. That's the purpose of that niche requirement. And there are other circumstances where a note could be endorsed to another lender, giving them the rights to enforce the note, but not necessarily giving them ownership of the note. There are two types of endorsements. One is an endorsement in blank, which would just be where Bank A would generally endorse the document to lender, non-specific, or a specific endorsement where Bank A transfers the note to Bank B.
So to punctuate for our audience, that when these transfers occur, it's essential for whomever decides that they need to enforce the note as a debt instrument against a borrower. They have to have an original note, either wet ink or electronically signed, and they have to have it either endorsed specifically to them or endorsed to blank, but they are in physical possession of that note. Is that accurate?
Exactly. And again, the purpose of that is to ensure that the debt is not duplicated.
So let's go ahead and map that out for a second, because I think perhaps many people don't understand what that means. So let me give you a hypothetical. If the rules that you're talking about didn't apply, and the original bank A or lender A sold the promissory note twice, sold it to lender B and also to lender C, would the borrower under that scenario be subject to double collection from both lenders B and C?
Well, under your hypothetical, if the rules do not apply, then yes, which is exactly why the UCC has these specific rules in place that must be strictly followed when a note is transferred between lenders.